Hello. In this particular session of security analysis and portfolio management, we are going to discuss about a fundamental concepts of risk and return in the investment context. Investors usually invest in the market for an expected rate of return, and if the return is incommensurate with the expected return, then they feel happy about it. However, the returns that is expected from different investments need not be one and same. It all depends upon the type of investments made by the investor and also the profile of the investor as such. Some of the investors may be willing to take some risk for a higher rate of return, whereas some of the investors like senior citizens may not like to take any risk for investments made by them. They will always like to have an assured rate of return of let us say 8% or 10% for as many years to come for that matter. So, in this context we are going to discuss about the basic concept of risk and return, and as we proceed we are going to discuss about the basic concept return, how do we measure it, basic concepts of risk, then we are going to talk about sources of risk, from where this risk arises, and we are also going to talk about how do we measure the risk of a particular asset, single asset. When we say asset, we mean only a financial asset. It could be a equity share, it could be a preference share, it could be a bond, it could be a debenture, it could be a short term instrument or long term instrument, whatever for that matter. As different discussion different types of financial instruments, for all the financial assets we can measure risk as well as return. So, coming to the basics of return as such, usually when the investor is expecting or investing in the particular market, he or she is expecting certain return as such, and the return is also known as something like a financial results of the same. So, suppose somebody invest in a particular share and at the end of the year the share may give something in terms of dividend or in terms of the change in the price of the investment as such. So, those combination these two can be taken as a return as such. We will once if somebody looks at the market, then one can find some of the assets offer a very high rate of return, some of the assets offer a very low rate of return, some of the assets may offer a constant rate of dividend, like some of the equity shares can offer a constant rate of dividend per this share, whereas some of the assets like equity shares may have different dividends for that matter. So, depending on the dividends on the asset or interest on the investment like debentures, bonds, and also the change in the market price in the investment, that amounts to the investment return for the investor as such. So, if you look at, so returns can be classified as historical or expected, that is your prospective return. Returns also can be classified in the terms of absolute as well as percentage term. When you say historical return talks about the return that has been there based on the past data. So, past dividend or past interest and past market price change. So, combination of these two will give you the return as such. However, the investment market is more of futuristic in nature. The past information can only give an indication that how it is going to happen in future. So, at the end of the day the investor like to know how much return is going to come from the investment in future. So, in that context that will be taken as expected rate of return. Another way one can also classify the return is that return is from a single asset, return is from a group of assets, which is known as a portfolio assets. So, when somebody is investing only in single asset, obviously portfolio is only of one asset, whereas some of the investors may like to put some money into real estate, some money into financial asset. In the financial asset, then you will have the assets like bonds, debentures, equity shares, preference shares, short term instrument, long term instrument, treasury bills, commercial paper, something like that. So, when the investor is going to have different returns from different assets like this, and when you take in an average and based on the weights of investments made in single asset, that is called return from the portfolio. So, the return from portfolio is essentially a function of the return from the single assets that the individual asset is holding. So, coming back, taking a simple example of investment, if one investment is purchased, let us say somebody has investment purchase, somebody has purchased an investment or in share, could be Reliance company or Infosys or Ranbaxy or any particular stock for that matter. So, in that stock or share we have typically two things that is coming from, that is one is the distribution of profit in terms of dividend to the equity shareholders, and second is the change in the market price of the share as such. So, when you come to the equity share in this example, so this particular investment is purchased at 120 rupees and it has been sold for rupees 132 at the end of 1 year. So, if you look at in this case, we have only a return given as the change in the market price. So, there is a 132 rupees minus 120, that is 12 rupees is the change in the market price. So, somebody has invested 120 rupees in the market and he or she has got 12 rupees extra by selling it after 1 year. In that case, 12 upon 120 appears to be 10% of the return that we have. So, next time that you have another example can be taken, another formula for that matter taken as we discussed earlier. So, we talk about the return in a way that represents total gain or loss on the investment. When we say total gain, as we discussed earlier, it is a change in the price plus any periodic payment that has come from the investment. So, periodic payment can be, as we discussed earlier, it could be interest or it could be dividend. Suppose we are investing in a bond or debenture, in that case we will have periodic terms of interest, and bonds and debentures can be held for a longer maturity or it can also be sold in the market in future. When the sales of the bond takes place, in that case the investor may have something more than what he has invested earlier or may get something less than what he or she has invested earlier. So, the interest component and the change in the price of the bond will be taken as the combined return on the investment that is made in bond. Similarly, in case of a instrument like equity share for that matter, instead of interest we will have something called dividends. In this particular formula, we talk about the return as the R for the time period T, and the price T is the T today, and price T minus 1 P T minus 1 is the price of the investment or the purchase price of the investment that you bought this investment before one period. The period could be 1 year, the period could be 1 quarter, the period could be 1 month, that is immaterial here, because we are going to find out the return for the period. So, if the period is annual year, then it becomes period per annum. If it is a month, it becomes a period, this return per month or per quarter for that may be, as the case may be. So, in that case, so we have the denominator has the original investment and the numerator you have the difference between the investments price today minus the original investment, that is P T minus 1, plus the C T, as we discussed, C T could be a dividend, C T could be a interest on the investments, and combination these two, that gives us the total gain that is made on the investment. So, that upon the price P T minus 1, that gives us the return during a particular period. The same return that we are talking about in the numerator denominator, that can also be classified as expected rate of return. In that case, we are talking the P T minus 1 as the expected, as the P T minus 1 is the price today and or a particular period before 1 year, and P T could be taken as the expected market price after the particular period, and the C T, that is the cash flow that is coming in terms of interest or dividend, that is the expected return in terms of dividend interest, that is for a particular period that is going to come in future as such. So, the same formula can be applied for calculated return for historical return as well as expected rate of return for any asset for them. There is no change in the formula. Only thing, the only difference is that in case of historical return, we have the data already from the market, whereas in case of expected rate of return, we have to forecast the market price 1 year hence or 1 month hence or 1 quarter hence, and also what is going to be expected from in terms of interest or dividend in during this next year or next period for that matter. So, that is the only difference as far as the historical return and expected return is concerned. So, usually in the market people talk about the future only, people invest today anticipating something in future. So, expected rate of return has a lot of relevance in the context of security analysis and portfolio management. Past information can only be an indicator, nothing beyond that. From the indicator and apply certain techniques, statistical techniques, we can forecast the expected price of the share or expected return in terms of dividend or interest from the particular investment by applying certain sophisticated or simpler techniques for that matter. So, going ahead, we have another example here. Suppose there is a company called ABC Limited, and as we know the share, and somebody has invested a share of that particular ABC Limited, and the share was purchased at rupees 300, and the last year what has happened, the company has declared some amount of dividend, and dividend per share comes to rupees 5. So, if the share of the ABC sells at rupees 340 today, in that case very simple here, you are one is going to get the 5 rupees of dividend, at the same time one is also going to get the difference between the market price today and the market price 1 year earlier, that comes here 40 rupees. So, 40 plus 5 rupees total return from the investor is now 45 rupees, and this 45 rupees of return is on the investment of rupees 300. So, that comes a simple calculation comes to 15%. Now, the question arises, what is the relevance of this particular figure called 15%? This 15% also could have been something less as discussed in the subsequent lines. So, in case the particular share is selling at 280 rupees, that means this investor actually has made a loss of 20 rupees, whereas the gain in terms of dividend is rupees 5. So, total that net gain or loss appears to be now it is only 15 rupees, that is a loss of 15 rupees. So, loss of 15 rupees upon 300 is come to something like 5% of the investment, that is loss. So, there is a loss of 5% on the investment made by this. So, whether it is a 15% or 5% depends upon the information that we have. It could be because of dividend and the mark. So, the return is a function of now the change in the price. When the price was up, obviously return was more. When the price is down, obviously the return is less, and there is only a dividend of only 5 as such. Okay. So, in that case, so coming to the point that what is the relevance of this 5% or 15% for that matter. In that case, how is going to relevant, that means what is the relevance of this particular figure called 15%. So, based on this return of 15% or whatever the percentage may be, we have got that tomorrow in the next year is going to be more than 16 or 17. So, this 15 can be only indicator, nothing beyond that. So, based on the, and moreover based on this 15 also, some of the potential investors can think of investing in it or not. So, assuming that this particular return is going to continue in the next accounting period or next investment holding period for that matter. So, somebody who is expecting a return of up to 15% or less than that, and that is the historical return, then one can think of investing this particular instrument. So, this 15% can be taken as a benchmark, okay, or a comparative framework that okay, this particular investment is offering 15%. Since my expected return is 12%, then I can as well go for this return, and I can go for making a buy decision, that if I have got a money, then I like to buy the share. Since this particular investment is giving 15% and my expectation is 12%, then obviously I can go for that. But if it is going to be less than 12%, that is a historical rate of return, then I will be thinking twice before putting money into that, because the what I am going to get is less than 12, but where I am expecting is 12. So, this becomes an indicator that whether should some investor invest in this market or in this particular stock for that matter. And this particular return can also be extended to the concept of index. So, instead of saying that what is the return on the a particular share, one can also talk about the return on the particular index. So, instead of saying that what is the return on index, typically we talk about the Sensex has gone up by 5%, 2%, it has gone down, Nifty has gone up by some percentage, there is a boom in the market. So, in that case what you essentially do, we compare the today's index value with the previous days index or previous year ends index, and find out the difference between these two index value, and find out okay, what is the change in terms of change in increase or is a decrease in the index. So, that gives an indicator of the market. Yes, market is going up. So, if the Sensex was let us say 17,000 1 year back, and it has become now 19,000. So, 2,000 rupees 2,000 points is the gain on the Sensex, and 2,000 upon 17,000, that something little less than 10% is the return on the index. So, same concept of return on its individual asset can be extended to an return on the index as such. So, going moving further, we have got something called a holding period return. So, holding period is something like this. you do not have to have a return for only 1 year. So, somebody can, or 1 period for that matter, somebody can invest the stock and hold on to that for more than one investment holding period. So, let us say investment holding period is 1 year, then we can also have more multiple of 1 year, like 3 year or 4 years, something like that. So, in that case the investor continues to receive the periodic interest or dividend over the years 1 year, 1, 2 and 3. At the same time there is also a change in the price of the investment over from one period to another period. If that is the case, so what is the holding period return for that matter? So, in this case we are saying the holding period is obviously more than 1 year, and we are applying a simpler formula to find it out. So, the holding period return, if you can look at, so what you do here, we just take 1 plus R 1 and R 1, R 2 and up to R n, n is the number of periods as such. These, if it is 5 year, it will be R n because R 5, and from the first year if you have got a 12% return and second year let us say you have got 13% return, then the first component this becomes 1.12 and the second component becomes 1.13. So, what you are doing here, you are just multiplying this all this 1 plus R 1, 1 plus R 2 and taking 1 minus, then doing minus 1. So, if you look at example, in that case let us say there is one investment which has given us in year 1 12%, in year 2 it has given 15%, year 3 it instead of giving something return it has eroded the value of the investment, and the return is actually negative, that is minus 8%, and year 4 and 5 respectively 15 and 16%. In that case we simply multiply 1.12 to the into 1.15 like that and find out what is the holding period return for that matter. So, the holding period return in this case that comes to 1.12 multiply the individual figures, and if you notice here in the year 3 for the 1 plus R 3 we have taken 1 minus 0.08. So, the return has been given in terms of percent, but for this calculation we have to convert in decimal and become 0.92. So, that into 1.14 and 1.16 minus 1, that is called 56.70%. So, in this case instead of taking a 4 year change in the market, so 5 year change in the price, as it is a 5 year holding period, we have taken the change in the price that is happening over a period of time every year as in. So, all the years of return has been combined, and with a suitable formula the holding period return of 4 years have come. So, it is not simply the addition of 12, 15, minus 8, 14 and 16. So, in that case it becomes how much? 30 minus 8, 22 plus 12, 34 plus 15, it is 49%. So, in the 49% actually the return is something like 56.70%. So, what is the reason for this particular difference is that, so since what you are assuming there is an assumption, fundamental assumption in the return context is that whenever the investor is getting something back in terms of dividend or something like that, it is supposed to be reinvested in the market at the same rate of return, same expected rate of return. So, that return gives us something back in the future. So, that is why the difference of 46.7% vis-a-vis the combination, a simple addition of these 5 returns of 49% has arisen here. So, moving on to the next one, that we talk about the expected return as such. So, unlike the historical return as we discussed some time back, in case of expected return, what we are talking is that we are predicting for the future with relevant values being predicted. So, the prediction can be there for different expected outcomes. So, let us say I will like to forecast the return for next year. So, in a particular stock called let us say IT sector stock, and IT sector stock the performance in terms of return can depend upon the overall market condition and also the industry condition in IT and some other industry condition, because particular IT industry's condition can depend upon the requirement of IT facilities of different other non IT sector as such. So, looking at that, if I am expecting that the condition the market is going to be very good, then I will say okay, these are the outcomes going to come, the revenue will be going up, profit will be more. So, because of that good condition, the investors like to buy the share at a higher price in some time hence. But if I am expecting the particular market is going to be down, then in that case these sales and profit everything, all those relevant financial figures are going to be less. in that case I will be having a less return expected as such. So, one is not sure about what is going to come in future. So, at the end of the day an investor has to forecast what are the possible outcomes, then zero on certain fixed outcome. Okay, these are the 4 possible 5 possible outcomes will be there, and under different outcomes this expect return is going to be there. And what is expect return? As we discussed in the previous slides, we have got the same thing, expected change in the price and expected dividend or expected interest, that is a C in the CT in the form of the formula that we discussed some time back. So, that RI is found out for each possible outcome, and for each possible outcome for a particular period we forecast this RI, and we also have to forecast what is the chance of that particular outcome taking place. So, if it is going to recession, how much chance, 20%, 30%, something like that. So, we will have to have forecast the as many outcomes as possible with the time and efforts whatever and the resources available with us and technique available with us, and in that we have to also have the outcomes, then associated probability of occurrence in that particular outcome, then we have something like the return expected in each possible outcome. So, if you look at the particular stock here, so there are 2 shares of A and B, and there are 3 possible conditions are expected. One is a boom condition where the things are going to be very bright for the companies, demand is going to be good for the product, sales is going to be very high. Another is a normal condition, and normal condition means that if whatever condition is there now it is going to repeat, and another is a recessionary condition where the bottom line, the top line of the company in terms of sales, bottom line in terms of profit, operating profit or net profit, all those things are going to be lesser in that case. So, in that condition from the investment A we are having an expectation like 22% in boom condition, 18% in the normal and recession condition 14%. Accordingly, we have some 3 different figures for this investment in B company share. So, when you do another calculation, you multiply the respective probability. So, in that case we are finding that 19.2% is the expected return from the stock A, whereas 19.8% is the expected return from the stock B. So, just to emphasize here, the expected return is a function of the probability of occurrence of a particular event or economy in this case, and the rate of return actually estimated in that condition of boom, normal or recession. So, unless we have these 2 sets of figures, we cannot find out what is the expected rate of return. So, if somebody is going to put a money into this market and will choose between A and B, obviously looking at if he rely on this set of figures, obviously the investor is going to go for a return of 19.8%, but if one make a close observation this particular data, that is 22, 18, 14 in one series and 24, 18 and 12 in another series, you will once can see that under the best circumstances the boom condition gives 24% return in B and 22% in A. So, it gives the little higher return in case of B. In normal condition both the investments options are giving same rate of return. Whereas, recessionary condition the company B which was giving higher rate of return in boom condition is giving less return compared to company A. That means, this appears that in a recessionary condition company B does bad compared to the company A, whereas in a boom condition company B does better in case of company A. So, instead of looking at the absolute value of 19.8% versus 19.2%, deciding that 19.8% is the better and shall I should always go for investing in that, one may say that no, there is a possibility that this particular there can be 12, the downside could be 12% in case of company B and it could be 14% in case of company A. So, keeping that in mind, somebody may change his opinion, no, I will go for company A, though the company's expected return is something less. So, here we are talking about the particular person may not be willing to take the risk of losing something, which we will discuss in the subsequent slides for that matter. Now, moving ahead in the discussion, having defined the return as such, let us now talk about what is the risk as such. As we discussed, risk is something very much inherent in the market. So, investors always will find out what is the risk involved in investing that. If the investor cannot bear the particular risk, then he may avoid the investment also. The best method of avoiding the risk in the business or in investment is that not to invest as such. So, when you do not invest anything, when do not do the business as such, so there is no risk, because you are not talking about any expectation, because there is no investment as such. But that is not the situation in the country, in the world for that matter. People do invest expecting something, and that expectation can go haywire, and you may get very high, you may get very less, but the measurement of the risk and anticipating what is the risk involved will help the investor take an informed decision that yes, when the investor is investing in the particular market, he or she rather he knows that okay, I am subject to this particular fluctuation, this particular change in the expectation in the market in future as such. So, that has to be there, and what is the we are going to discuss where what is the how this why this risk arises, why this 12 can be 14 or 16 or 18 for that matter, and why cannot it be something more or something less, and how it is affected by who what affects this particular risk as such. So, if you go to the definition of risk as such, it is what happens as you discuss, there is nothing certain in the world, everything is actually uncertain, and only uncertainty actually drives the market. If everything becomes certain in the market, then all the investors come to know about that particular stock or investment is same information, then they are going to price the particular investment at the same price. If the investor A and B or you and me price the particular asset at let us say x rupees, in that case I am not going to buy or sell that share, because you are not going to buy or sell buy from me. So, I can sell because you are expecting it is to be x, I am also expecting to x. So, in that case since there is no difference in the price that is perceived by two investors, so there will not be any trading that is taking place buying or selling, and there is no buying or selling because we are now certain about the share price, and since you are certain about the share price, I will price at x means you also price at x. In that case, there is no trading takes place, and there is no trading takes place, then your if you plot the particular graph for this particular investment, then if you have a graph like this, and where you have got the time period in the x axis, and you have got the price of a particular security in the y axis, then if everybody is expecting the same price, it is x, then the price will, the line will look like this, because there is no investment, there is no buy and selling of the share. So, the price remains constant, whereas typically in a market any investor will always like that the price of the particular thing fluctuating. So, when there is a fluctuating like this, something like that, that means there could be uncertainty involved, and this type of graph of fluctuation is only appreciated, whereas a straight line in terms of graph, when there is no buying and selling, price is one and same, there is no possibility of gain or loss, is not accepted as such. So, that is why uncertainty is involved, and uncertainty only leads to the price of the particular share or the market fluctuating over a period of time as such. Certainty means it becomes a straight line parallel to x axis, which is never liked by any ordinary investor for that matter. So, moving ahead, so investment is always associated with the certainty, it is uncertain, then it is different, if it is certain it is something different, if it is certain our investment profile is going different, if it is uncertain it is going to be again something different. So, in the context of investment, risk is defined as chance of suffering a loss. So, what is the chance that my money will be lost to some extent? So, that is the risk as its risk need not be that what I am going to get. So, this is ultimately how much I am to lose by investing in this. So, if I am willing to lose something and can bear that, then only I am willing to take a risk. Your risk cannot be only that I am going to take a risk to gain something in the market. Risk is in very simpler term in a financial market, any investment parlance is that I am likely to lose this much under worst circumstances, it is going to happen. So, coming to next, so anything that you have got a greater chance of loss, okay, then that is talking to be more riskier than any investment that is got lower chance of loss. So, if there is a 10% chance of losing by x percent, and there is another company where you have got 30% chance of losing by x percent, then obviously second company which has got 30% chance of losing is taken as a more riskier, and the 10% chance of losing is taken as a less riskier. And risk also can be interchangeably used with the term called uncertainty. Uncertainty is, as you discussed in the previous graph for that matter. In this case, we have the fluctuation here. So, on because it is uncertain, you do not know it is going to go up or it is going to come down, or again go up or again come down. So, what is going to be expected in environment? So, because uncertainty only this particular investment is price is going up or coming down. So, risk is also associated with this uncertainty involved in this particular trend in the price in the given asset. Now, what is the reason for the risk? What makes this particular graph fluctuate? It is going up or coming down, or what is going to be straight line for that matter. There are different types of risks in the market context, in the farms context for that matter. Some of the risks can be specific to the investment made in the particular company. So, the company specific are also known as farm specific risk. So, farm specific risk can be again classified as two way, that is, one is your business risk and second one is your financial risk. So, business risk is something that what is the chance that the sales will take place or sales will not take place. The chance that sales will go up by 30% or sales will come down by 20%, and what is the chance that my expenses will go up or my expense will come down. So, something essentially related with the operating environment, that is the internal environment, operating condition of the particular company as such. So, that is the cost structure will change, there will be more fixed cost, there will be more variable cost, something like that, more revenue or less revenue, one particular product may be hyped up or new products may be introduced, which will lead to higher sales, will lead to higher margin. All those things can come, and there is an uncertainty involved with that, and nobody can say that how much is going to sales taking place in future by 20 to 30% for all certainty. So, there is a chance that sales may go up by 20%, sales may go up also by 30%, sales may eventually come down depending on the market condition. So, if the particular company is selling something like a regular day to day item like grocery items for that matter, in that case vis-a-vis a company which is selling a consumer durable goods. So, company who is selling a grocery item for that matter or for a small kirana store, small store, obviously in those case the demand for the item sold by this particular store is going not to be fluctuating much, because the basic necessity is taken care by this particular store. So, all the people are going to consume almost the same quantity as such. So, in that case this risk that the sales will not go up or something like that is very less compared to a FMCG or compared to for that matter your consumer durable goods, white goods for that matter. So, more number of TVs may not be sold, more number of refrigerator may not be sold. So, in those consumer electronics company, so that can be subject to the vagaries of the market more than a company which is selling day to day consumption items. So, the business risk is essentially related to the type of business this company is into. Depending on that, the business risk could be high or low. Next thing is that, and the business risk also talks about something, there could be something like the company is having a huge establishment like your big market, big bazaars, big shopping complexes for that matter. So, there is a lot of space hired by this particular entity, and this space has got a lot of rent to pay. So, whether there is a good footfall is there or less footfall is there, less people visiting or good number of people are visiting this particular establishment, you will always have the fixed cost like rent, the minimum AC condition, that electricity charge for that, the floor, minimum staff is always going to be there. So, in worst condition in the market or best condition market, this cost is going to be fixed. So, having the presence of high fixed costs or fixed cost in the structure of the cost of this particular company or the unit or the product can lead to more risk, because in a very bad condition they can recover the fixed cost, and that itself can lead to a loss making proposition for the business. Whereas, if the revenue is more and more, your fixed cost is not going to go up, only variable cost is going to go up. So, the fixed cost gets spread among number of units and the bottom line of the company can improve. So, that is also another source of business risk in any company. Another thing that you have is called the financial risk, and when you say financial risk, it is in terms of the obligation, the financial obligation of the particular company. So, financial obligation is something like financial cost, like we have got something that typically there are two different sources of finance for a business. One is the source through debt, that is a loan, the borrowing, and second one is the source through the owner's money or the equity assets. So, as far as the borrowing is concerned compared to the equity assets, in case of borrowing we have a interest payment to be made. So, the company makes profit, a company makes losses, interest has to be paid. So, there is a fixed obligation in terms of interest the company has to honor. At the same time, the company also has to honor the principal repayment if it is due in certain point of time. Whereas, in case equity, you do not have any compulsory tag that the equity share must get a particular amount of dividend. In that case, the dividend can be there, dividend is optional for the company to declare or not, subject to certain legal restrictions, and the company may feel like declaring dividend, may not feel like declaring dividend, because the money they require could be high in case of for their internal requirement or expansion, they may choose not to declare in dividend. At the same time, there is no obligation for the company that the company is going to give the money back to the equity holders. So, in that case, there is no obligation in case of equity shareholder to give back something to the investor, but there is an obligation for the company towards debt holders or to the creditors who are supplying loan, to bankers who are giving loan, that they must pay an interest. So, what happens in that case, if there is a bad condition in the market and the profit of the company declines, then if there is an interest component which is fixed, the interest component has always to be taken care. So, in a worst condition, bad, good condition, the interest has to be taken from the profit, then you find profit before tax and then find the profit after tax. Whereas, in equity you do not have the reduction in the interest. At the same time, presence of debt can also be good for the company if the company is doing well, because having paid the interest component, then there is no compulsion that you have to pay something more if you are making more profit. So, in a very good condition, the having debt in the particular company is actually good for the company, but the bad condition having debt is actually not a good thing for the company, but it is there is no luxury for the company or the management to change the capital structure or the debt equity component and then say that because the market condition is bad, so I will reduce the debt, and market condition good, I will go for more debt. So, the company has to be very careful when you go for more debt or less debt for that matter, and in that case, so the financial risk is going to be higher in the company which has got debt in the capital structure, which leads to something like interest obligation for the company. Then coming to the next type of risk is called investor specific risk. In investor specific risk, we have got something called interest rate risk, liquidity risk and market risk. As far as interest rate risk is concerned, so interest rate risk something like this. So, the investors expected rate of return is a function of the interest rate environment in the market. So, the overall interest rate of the in the market is going up, then your expectation from the investment in the interest in a bond or debenture is also going to be higher. And since you are going to expect more interest in the investment like bond or debenture, and if you are investing in equity share for that matter, you will always expect a little higher return that you expect from the debenture. So, underlying condition is that overall market interest condition changes the expected return of the investor as such. So, the interest rate is going to go up or go down, accordingly it is going to the expected return of the company is also going to change. So, the risk and at the same time the interest rate fluctuation can also lead to the change in the interest paid by the company. So, because of that there is a risk involved for the investor, and investor may expect more or less depending on the overall interest rate environment. Next thing that you have is called liquidity risk. Liquidity is something in the market is that how well I can sell the share and get the money back, that is the liquidity. Liquidity means converting your investment into cash or converting your financial assets into cash. There may be some category of shares which are highly liquid. You always have market, there is always a buy or sell quote, or there is a ready-made market, you enter the market through the broker and whenever you want you can buy or you can sell. That is called the liquidity in the market. The share is quite liquid. If you have the share you can sell for cash, or if you have the cash you can convert into a share. But there may be shares where there is no trading taking place. Trading does not take place means for some reason the share is not attractive, okay. Maybe not a lot number of shares are available in the market for buying and selling. So, in that case there is a liquidity risk. So, the liquidity risk is going to be higher when the company is going to invest in this particular market in that particular share. Obviously, the return is going to be expected to be higher, because the risk involved in this particular instrument is high, because he cannot easily liquidate his or her investment and get the cash back. Then next that you talk is the market risk. Market risk is something which is not in the hand of the investor. Overall market, there is like index like Sensex or Nifty, CNX Nifty for that matter, will go up or come down based on different circumstances, overall government condition, whatever that happens. In that case, there is a market risk involved, and the overall market risk is up. People, everybody in the investment market, they feel that the market is going to be more volatile. Obviously, the all investors also are likely to feel in that way. So, and that is something risk which is not in the hand of the investor. Then coming to the next category, that is called farm and investor specific risk. So, in farm and investor specific risk, you have got something called which is affecting both the farm as well as the investor assets. So, there is something called event risk. Event risk means there is, let us say, there is some big accident that takes place, likely to happen or something, it is taking place, a fire that takes place, or the top management of the company is running into some legal trouble as such. So, this particular risk is some event specific, and this event specific risk is not related to any other company or any other share for that matter. This is only specific to this particular company, where the expectation of the investor is affected, as well as the performance of the company is also accepted. So, that is called the event risk, and if for any reason there is likelihood of this, because it is very difficult to predict such things going to happen, but somebody can also capture based on the past history, can say okay, such things can happen in the case of this particular company, then one can actually account for that. The next that you have is called the exchange rate risk. So, exchange rate is something which is nothing but the fluctuation in the forex rate, let us say, and for which type of company it is going to be affecting more. The companies which are having in their cost structure something which is a dollar denominated or a euro denominated or a pound sterling denominated items as such. So, if the company is depending on the foreign currency, whether for the incurring of expenses or for the revenue for that matter, there could be so many companies where there is no expense in terms of foreign currency, but there is only revenue in terms of foreign currency. So, if you look at look back, we will find that some of the IT sector companies, they showed a less amount of profit and sales, because the overall forex market, the rupee has been Indian rupee in the compared to dollar had become stronger, and the realization from each dollar was actually less. So, though the activity of the company had not declined, there is no decrease in the volume sold, but the value of the sales or value of the revenue for that matter was lesser because of the reduction in the forex rate for that matter. So, if the company's revenue depends more on such revenues like export sales or export of services, export of products for that matter, and those companies are subject to obviously high financial risk. At the same time, there could be some companies which may source their raw material, critical raw material or whatever raw material from outside. In that case, the cost structure of the company can change because of the change in the forex rate as such. So, those companies which depend upon certain critical resources or the regular consumption of resources, and they depend on the outsiders outside the country, where there has to be a forex payment in terms of dollar or something like that, then in those cases also the forex risk is going to be higher. Next thing that you have is called the purchasing power risk. The purchasing power risk is nothing but the risk in the price level of the economy, as something like inflation risk as such. So, if the companies can change their revenue and everything can change commensurate with the price level, then nothing like it. So, the price level risk or purchasing power risk is actually arrested, because you could change the market price or product based on the inflation or whatever is taking place. If the companies cannot do that, then it becomes a bigger problem as such. So, the company's ability to change its sales, to change the cost in relation with the general movement, the price level, if that is there, that company becomes actually little riskier, otherwise it company becomes more riskier. Then next thing that you have is called the tax risk, and tax risk means the government may suddenly declare that a particular sector of the economy is going to be taxed at this particular rate. Possibly this particular company, maybe in a sunrise sector or an export processing zone or export oriented undertaking, which was not subject to any tax, or there is an incentive for that company that there is no tax to be charged, corporate tax is going to be charged, and in that case if the company is going to be subject to tax because of new law or new notification of the government of the country as such, then in that case the risk is actually higher, because now the company is going to pay tax, or even if the tax was there, there is a possibility that the overall tax rate, corporate tax may change. What is now let us say around 30%, it may become 35% or it may become 25%. So, the expected change, typically in this case upward change in the tax rate can be, if there is something like that is expected, then it is more riskier for the company as such. And then having said that these are the different sources of risk for any company for that matter, in the context of investments we do classify the risk into two types, that is called systematic risk and non-systematic risk. When you say systematic risk, that risk is something which you cannot diversify or which you cannot reduce. Okay. Whereas, unsystematic risk is something called unique risk, otherwise known as unique risk or the diversifiable risk. This unique risk is something which is unique to the particular investment, the share or bond, whatever that may be. That means, I can avoid this particular unique risk by possibly not investing in that. So, I do not have any unique risk. Okay. Whereas, in case of systematic risk or diversifiable non-diversifiable risk, in that case you have got something which you cannot diversify. When you say diversification, diversification is something like reducing the risk by having more financial assets in the portfolio you have. So, if you have got a more riskier asset, then instead of putting all 100 rupees in the riskier asset, you can put maybe 60 rupees in the riskier asset and 40 rupees in the non-riskier asset. So, in that case the overall risk of the portfolio of 100 rupees is going to come down, but there may be some risk which is non-diversifiable, which is a function of something like a market, which is not in the hand of the investor. However, diversification you make, that risk cannot be reduced. It is specific to the market. If the market is up, then your share price may be up, because share price could be fluctuation of the market index as such. So, you cannot do anything about, because that is not in the hand of the company as such. Whereas, like something like we talked in the previous in the first point, that is your business risk and financial risk, in that talked about those business risk and financial risk of a particular company is something like a non-systematic or diversifiable risk. So, possibly the company itself can change, or I can change from one company to another company. Even if I change from one company to another company my investment, my systematic risk is not going to reduce as such. So, when you discuss in the context of portfolio, the portfolio theory that you are going to discuss, it will be discussed in subsequent sessions of security analysis portfolio management. We essentially talk about reduction of the risk through having a portfolio, and the reduction risk is something like reduction of the non-systematic risk, systematic risk is not being reduced. So, these are the common sources of risk that we have discussed. Now, moving on to the next part, as an investor is concerned, there are different types of investors. That is, your theoretically you have a risk neutral investor, you have a risk averse investor, and you also have a risk seeking investor. Risk neutral investor is somebody who does not bother about the fluctuation, he does not bother about the risk involved in that. Quite unlikely you will find some people who does not bother about risk. While risk averse is somebody who is actually not willing to take that much risk or relatively less risk. He actually tried to avoid the risk. Okay. So, in that case he will always look for a higher return from the investment for any risk taken. So, the per unit risk taken, the return that is expected by risk averse investor is going to be higher as such. For the risk seeking investor, he is the person who is always going to take risk, though the return expected would be less, but he is still willing to take the risk as such. But having said that, it is a risk neutral, risk averse, risk seeking people, by default investor are risk averse. Only the relativity of risk averseness can be differing from you to me or you to someone else, but by default we will always be risk averse. We may become a risk taker up to certain level of investments. Beyond that particular investment, it can become more risk or less risky depending on the investor as such. So, coming to that, So, relatively we say that risk averseness, as one person can be more risk averse, one person less risk averse for that matter. Moving on to the next one, if you look at a particular this graph here, you have a two stock called stock A and stock B, and in this case you see the return that you have the ranging from minus 20 to plus 50. So, and the return variation, this if you look at normal curve that is plotted here, you have something that is more flat. So, obviously, compared to stock A, compared to stock B is more riskier, is flat, it is more flat, or stock A is actually less riskier, because the variation can be from 0 to something like maybe possibly 20 or 30%, but not like 50%. And if you look at risk of that, you come to risk of a single asset, we have in this, let us look at this particular example. This example has got economy of condition like recession, below average condition, above average and boom condition, and each condition has got respective probability, and you have got a government security investment, you have got a stock 1 to stock 4, and if you look at that, you have got expected return, that this particular return expected has been found out by applying the formula that we discussed in the previous slides as such. Okay. And in that we see here the expected return for different investments like 8% in case of GSEC, 17.4% in stock A, and like that 15% in case of stock 4. So, depending on the expected return for different conditions, we have got the expected return for the different stocks, that is expected to applying the particular formula. So, if you look at that particular chart, in that you find that the recession, the recession condition or a good condition or a bad condition, the government security has got the same rate of return expected. So, there is no risk involved, irrespective condition the return is same. Whereas, in case stock 1 to till 4, we find the stocks which has got different returns based on different circumstances. It is not constant like your treasury bill for that matter. So, stock 1 if you look at, it moves more or less along with the economy is down, the stock return is less, economy is up, the stock market, the stock return is actually higher. Because stock 2, it is something, it is opposite direction, where the return is good in the condition is good in the market, the return is good, sorry bad, whereas the condition is bad in the market, the stock gives more return. So, the second stock is called negatively correlated to the market, or the first stock is called positively correlated to the market. Then the coming to measuring the risk of a particular instrument, if you look at GSEC, the fast measurement, the simpler measure risk is the range. Range is something like, if you have got expected return, like in the case of the previous table, the expected return for stock 1 is minus 22 in one extreme and plus 50 in another extreme. So, the difference between minus 22 and plus 50, that is around 72%, that is the range of that means return, it can fluctuate from minus 22 to plus 50%. So, that way the range between the two extreme items, the lowest one and the highest one in the expected outcome. So, that is 72%, 48%, 55% and 56%. So, looking at this particular table, we feel the stock 1 is the highest risky, where the GSEC has no difference in the return, it has got 0% range, because the highest is 8 and lowest is also 8%. So, relatively you can say the stock 2 is little less riskier than stock 1, and obviously then stock 3 and stock 4, the category will be first one is 72% stock 1, then stock 4, then stock 3, stock 2. But this is a very crude or simpler measure for that matter, it is not a very scientific or mathematically sound measure. So, for the mathematical sound measure, we do apply in technique called standard deviation or variance. So, variance, as we know, variance is nothing but the square of the standard deviation, or standard deviation is the square root of variance. So, how do you find out the variance? In that case, the standard deviation or variance for that matter, it is what we are doing here, we are taking the difference between the expected return that we calculated in the table at the end of the table as such, like for that you have got 17.4% in case stock 1, and then you did and found out the difference and then square that and multiply the expected probability that particular thing happening. Then summation of these all those items gives us the variance, and when you take the square root of that, that gives you now the standard deviation. So, if you look at in this stock 1, what you took in the first possible case, you have minus 22%, whereas the expected return is 17.4%. So, take the difference between minus 22 and 17.4, square it and multiply the 0.10 and do that for all possible outcomes, and the standard deviation of this, when and adding all these figures and taking the square root of this particular thing, that is doing that 1 by 2 is the power there, that is called 20.0%. Similarly, when you look at the standard deviation is coming to 0% and 20%, stock 2 is 13.4%, stock 3 is 18.8% and stock 4 is 15.3%. So, if you look at, in this case the stock 1 appears to be the highest risk, whereas stock 3 is the next highest risk and stock 4 the next higher risk and stock 2 is the next highest. So, among the stocks, that is, or stocks or shares available, the stock 2 appears the least risky instrument when the risk is measured in terms of standard deviation or variance for that matter. Whereas, government security, since there is no fluctuation in the expected value, so there is obviously the risk is actually 0%. So, this is the way one can find out the standard deviation and find the risk as such, and one can as well extend this particular concept of risk and return to finding out the risk in the context of portfolio, which one can discuss in the case of portfolio theory. And if his return in the portfolio is concerned, then in that case we have the weightage of the different investments made 20%, 30%, whatever that may be, multiply the weights with the respective returns of different securities and then combine them and find the return. And for portfolio return we have a different, portfolio risk we have a different formula which can be discussed in subsequent sessions. Thank you.